And we are very pleased today to be able to welcome a phenomenal VC and my friend, Will Porteous. Will is the general partner and the chief operating officer of RRE Ventures. During his 17-year career as an investor, Will has served on boards of more than 20 companies. He is currently a director of Breather and BuzzFeed and Paperless Post and Pilot Fiber and Spaceflight and Spire. And Will is also an adjunct associate professor at Columbia Business School. In addition to all of this, Will holds degrees from Harvard, the London School of Economics, and Stanford University, and is an all-around great person. And we are so pleased to have the advice and expertise of Will. Thank you for joining us, Will, and we can't wait to hear what you have to say.
Thank you, Gwen. That was a very generous and gracious introduction, and I am really delighted to be here with you all today and to talk about how we think about financing the new aerospace company here at RRE. This has been a big area of focus for us over the last few years. We have I'll talk a little bit about the background of the firm in a few minutes, but we have a long-standing practice in hardware and systems. And through that lens, we've witnessed these dramatic sort of inflection points happening in the aerospace industry. And the 1,500 participants in the GoFly competition are a testament to that. You know, I was absolutely blown away when I sat down with Gwen to talk about Boeing's commitment to this area and the quality of the teams that were coming forward to participate in this process. And it's a real honor to be included in the curriculum. So what I'd like to do in the next hour is talk a bit about how we think about financing the new aerospace company. I'm going to talk about our firm. I'm going to talk about the investing process of venture capital firms like RRE. We talk about the different phases of startup financing, and I'm going to try and give some very specific, very tactical advice for entrepreneurs who are raising money from VCs. And this material has grown really out of two activities. We get asked a lot for our views on the wave of innovation in aerospace, and in particular in certain sectors like satellites and rockets, which are not directly relevant to this competition, but there are some common themes. And also, this comes from material that we developed for our course at Columbia, where we've taught for a long time. My partner, Stuart Ellman, and I have a seminar on venture capital that serves second-year MBA students. And we will make time for Q&A at the end. I find questions are often the most interesting and informative part of a discussion like this, and I hope that, Paul, you'll help keep me on track in terms of timing and that sort of thing. So just by way of background, RRE Ventures is a leading New York-based venture capital firm. We're one of the most active early-stage venture firms based here. We were started more than 2 decades ago. We manage $1.8 billion across 9 funds, all of which are dedicated to early-stage companies. And with that capital, we've invested in over 280 companies. It's an active portfolio of about 130 companies. And the core of our investment team has been together for a long time. The founding partners are still actively leading deals. And the firm has always been known for the strength of its access to Fortune 100 companies, and particularly to senior decision makers. And I think that's particularly relevant in an industry like aerospace, where the innovative company that has built a great new product still needs distribution, still needs to be able to provide service and support. You can't get customers without being able to support the entire value chain. And my sense is that the leading aerospace companies like Boeing and others are going to be partnering with many of the innovators in this wave in a variety of ways, which might include that. Among our notable portfolio companies, we are active as investors in a diverse set of sectors. So In the media sector, we're early investors in companies like BuzzFeed and Business Insider and Giphy. In financial services, we've been a leading investor in a variety of alternative lending and payments companies. And in hardware and systems, we've done quite a bit around 3D printing, solid state storage, networking, telecom. These are core areas of focus for an early stage venture firm like RRE. And our interest in the aerospace sector really began with a lot of company formation that we were seeing going back 4 or 5 years now. And that led to an aerospace portfolio that today includes 2 small sat constellations, Spire, which is focused on weather data gathering and asset tracking, and Spaceflight, which is a next generation broker of launch capacity. They're essentially a travel agent for getting things in space. And finally, Black Sky, which is a new optical imaging constellation and software platform. Very relevant to this activity, we were seed investors in Airware, the operating system platform for the drone market. We have also done quite a bit around propulsion technologies, next generation propulsion technologies, and Action Systems is an investment we've made in that area. And finally, URSA is a software platform that's really dedicated to image analysis for overhead reconnaissance applications, both radar-based imaging and optical imaging. That constitutes our aerospace portfolio today. I believe we will do more in this portfolio, and I believe we will do more on the hardware side in the years to come. Mostly because we see this dramatic wide open opportunity where costs of creating capability have fallen dramatically, and we see small teams doing great, frankly, breakthrough work to deliver those products to market. So let me talk a little bit about the investing process generically. The point of this section is really to give you a view, first of all, of the world that we live in. So let's start by looking at how a venture fund actually operates. So here on this chart, you have 3 core constituencies. You have in the middle, you have the general partners of a venture fund. That's people like me and my partners in the firm that we run. Every couple of years, we go out and we raise a fund from a group of LPs, what are called limited partners. These are institutional investors, high net worth individuals, family offices, and we put in our own capital. And we create a pool of investment dollars that are typically chartered for 10 years. It's 10 years that we can call the capital down anytime we want, and we're expected to make investments and return successful, profitable proceeds to our investors. And we'll talk about that process in a second. Very often those funds go longer than 10 years. They end up being extended out for 12 or 15 years in many cases. We as the venture fund call capital from that pool of investment, and we invested in a number of companies. And so if hypothetically we invest in 9 companies out of a fund, the $2 to $10 million that RRE might invest in a company, let's say hypothetically, is going to own a 20% stake. And on the right here, you have the constituency of founders and their management teams and their employees in each of these, quote, startups. Now, what's going to happen over time? We will make those commitments over a period of years, and those companies will begin to mature. And at some point in the future, they'll begin to have realizations. They will either go public or they will be sold. And so let's look at what happens. In the case of a hypothetical billion-dollar outcome, most of the proceeds will go to founders, employees, and of course shareholders. If RRE's venture fund owns a 10% stake, well, that $100 million will flow back towards the firm. And that $100 million, first, we will deduct the cost basis associated with that investment. And then we will return that cost to the limited partners. And then we will return 80% of the profits. So that's the 10 million of cost return that you see here. And 80% of the remaining profit $72 million, and the venture fund retains $18 million as profit, which is split within the firm. Pretty exceptional way to make money when it works well. The challenge, of course, is that not every deal becomes a billion-dollar outcome. And in fact, the distribution of outcomes in a venture portfolio follows something called the power law. What we mean by this is that in a hypothetical portfolio, typically 1 or 2 out of as many as 50 companies will drive the bulk of the returns. And so you see here the return multiple on the y-axis, you see the number of deals. In a given RRE portfolio, there are typically 20 to 25 companies. Of course, on day one, when we make those investments, we think they're all going to be exceptional outcomes. But statistically speaking, we know that this is true, that the deals on the left side of the page here will likely drive the bulk of the performance, and we just don't know what those companies are going to be in year 1, 2, and 3 when we're initially making the investments. Now, that is not to say that there's no value on this side of the page, and this is a crucial thing to recognize about what's happening in aerospace right now. There is a tremendous amount of value that's going to be created over here. If our venture dollars went in over here, likely many other venture firms invested alongside us. And that collective pool of capital is helping to create new companies, which, while they didn't make it as businesses, an awful lot of capability has been created, and that capability may end up being partnered with or even acquired by other companies in the sector or legacy companies. So something to bear in mind if you're sitting on a larger aerospace platform and potentially have the opportunity to partner with or acquire some of these companies. So let's look at the life cycle in this business. Where do deals come from? You know, we get 5,000 plus business plans a year at RRE. And I will tell you that we focus our energy and attention on 200 of them. And those 200 typically come to us through a network of relationships. They're referred to us by entrepreneurs that we trust, by co-investors that we've made money with, by lawyers who we have a high opinion of, by consultants and industry analysts who know that we're interested in this sector. And in general, when we're interested in a sector like aerospace, we try and meet as many of the leading companies as we can to inform our process before we actually start deploying capital. That sourcing process is supported by a disciplined decision-making process. We'll come to that. When we've decided to go forward with a deal, there's obviously the presentation of an offer to the company and the negotiation of terms. And if a term sheet is finalized, we will then work with management to select co-investors to sit alongside us. We are not majority or control investors, nor are most venture funds, and we tend to operate in syndicates with other partners that typically we've worked with before, and likely they share our value system and approach to helping these companies. There is in this business this idea of a lead investor. That is, I like to put it in terms of who is the entrepreneur going to call? When things are rocky, when they're facing challenges, who do they call outside of their immediate management team? That's usually their lead investor. And we very often play that role in terms of working closely with the management, both inside and outside of a board context. That may providing general oversight support, business development support, strategic relationship support, and certainly helping to plot the path to the next major financing. And over time, there's a role for the venture firm to play in helping the management team pursue liquidity. And when we're able to do that and return capital, like we described on the previous pages, then we get to go out and raise another fund, and the process continues. So, against that backdrop, how do we really make decisions? Well, an enormous amount of investing in the early stages is about choosing the team that you're going to work with. This is a slide of the famous PayPal mafia. If you were to have backed the folks on this page, all of whom worked together in the early days at PayPal, you'd have been extraordinarily successful. They went on to found YouTube, Palantir, Yelp, RRE Ventures, Founders Fund, Yammer, LinkedIn, Affirm, Tesla, and SpaceX. The point of this is twofold. We're not just looking for high achievers. We're looking for exceptional minds and personalities. And very often, those minds and personalities tend to flock together. They like to work together. They like people who can perform at their exceptional level. More generally, when we look at a company, we focus on the first 5 to 15 people, because we recognize that the first 5 to 15 people in the door can determine everything about the future trajectory of a company. That's the phase in which you build culture and values. Strong teams attract strong players, and as they scale, they create cultures that will not tolerate weak performers. Lots of attention should be paid to keeping culture and values healthy, but at its most basic level, the venture capital business is about building high performance teams. And a huge amount of our work in aerospace today is around this topic, because many of the legacy teams that are coming out of older aerospace environments aren't necessarily financeable on a standalone basis against these kind of standards. And many people who are coming into aerospace right now don't have the aerospace background that they need to really make the right choices early in life. And so finding teams that bridge those two gaps, those two worlds, is a crucial part of building companies in this sector. Now, continuing kind of with this line of generic thinking about the way we make decisions, those exceptional teams need to be doing something worthwhile. It's no good recruiting an amazing team to build a company whose success won't be important or valuable. What they're going after has to be both audacious and plausible. And so, you know, it's not that it all has to be world-changing, but there must be not just a certain comfort with risk, but a certain realism around achieving some pretty exceptional things. And so I like this slide, frankly, because it reflects a high tolerance with risk alongside a lot of concern for safety and safeguards in the way you build companies. Now, much of our decision-making comes down to understanding where we are in a given innovation cycle and identifying potential step function shifts. Venture investors are looking for innovation that enables something that's 10 times better, but really ideally 100 times better, in a moment in the market where it's possible for new entrants to insert themselves, to build new and build new industry leaders. And when you find a moment like that, the follow-on effects are enormous. All of us on this call are familiar with the impact of GPS technology on our lives. The transition to from paper maps to handheld GPS devices was just the beginning, as we know. Once that capability became cheap and easily embeddable, a vast new universe of applications began to emerge. One that, frankly, I think went beyond anyone's wildest imagination in terms of what was possible. Today, we take for granted the fact that our phones are passively aware of our location at all times and can serve up opportunistic information on that basis. So with that kind of philosophy as a background, let's talk about what VCs look for. We've talked about the team. Let's talk about some of the other elements. The market, we'll talk about markets and kind of the issues of fast-growing markets versus big markets. We'll talk about product, and we'll talk about kind of the deal and terms. When you're presenting to VCs, a couple of things that just always matter, that always get above the noise. Customer validation. The team that comes to us to pitch, that comes in talking about customer validation, proof points out there, customers who want to buy, customers who have tried, always gets taken more seriously. Teams that have worked together before, that have a prior track record of collaboration, always get taken more seriously. And frankly, persistence and tenacity matters, because it also tends to translate into a sense of responsibility to investors and shareholders down the road, something we have to pay a lot of attention to. We've talked a little bit about innovation and the desire for step function increases. And then, of course, we do pay attention to who else is paying attention, other investors and the advisory board. So let's look at the nuts and bolts of the process. There's an introductory meeting. In that introductory meeting, there is a deck and hopefully a product demo of whatever capabilities might be there. For those of you who are building physical vehicles, that might mean a second visit or a second meeting where the demo actually happens. The company visit is a crucial third meeting for us. And by the time a company visit is happening, you as a team should expect that the deal opportunity has been socialized within the firm. If the first 2 or 3 steps have happened here, if the company visit isn't combined with a first meeting, by the time you get to a third meeting, you should be hearing back about the decision-making process, the outstanding questions that the firm expects to explore in due diligence, and the partner or principal who's leading the opportunity should be trying to get a handle on on evaluation and terms and the amount of money that's going to be raised. I highlight that because often when I talk to entrepreneurs, I get the feeling that they don't know where they stand in the process. And you should always feel like you can ask where things stand in the process and what the pathway is for reaching a clear conclusion and decision. After that company visit, there's often due diligence, which will take the form of analyzing your financial model, looking at the bill of materials, having an outside engineering consultants review the build and the program, reviewing test flight data in this case if it's available, viewing component test data if you're doing original component work. And all through that process, you should also be talking about the development of a term sheet proposal so that when you get to a final decision meeting, you know exactly what deal you expect to get out of it on the other side. After that, with most firms like ours, if you get to agreement on a term sheet, there's just the process of filling out the round and then reaching closings. When things are competitive, this process can be compressed into as little as a few weeks. Again, though, overlying all of this, there's a set of questions that VCs are actually thinking about. Is this a big enough, fast-growing market? Is there a real pain point? Does the whole thing kind of make sense? And if so, are these the people to do it? And lastly, we jokingly put on here, am I still awake? But I think you have to recognize that for investors in early-stage companies, the decision to invest involves a certain amount of faith. Products aren't finished yet. Customers aren't buying yet. Revenue's not flowing yet. And for the investor, it's an act of belief. It's an act of belief in a team, in a market opportunity, in an innovation, and you have to love it. I mean, the journey that we've been on at RRE with some of our companies is something that we're incredibly proud of. And in many respects, when they get to high levels of scale and success, there's a lot of emotional gratification for the investor. Good deals tend to follow that pattern. So let's talk about the deal, because this is, at the end of the day, a financing exercise. From the standpoint of entrepreneurs raising money, you should be thinking about equity allocations, both between the founders and future employees, both the employees you have today and those that you will hire, and then what share of the company is going to go to investors. We'll talk about dilution by round in a few minutes. You also need to bear in mind the number of investors or firms you may need to work with over time as you raise money in subsequent rounds. And the fact that venture firms, at least early stage venture firms like ours, typically look for 15 to 20% ownership stakes. And that number should matter a lot to you if you're raising capital, because frankly, there's a threshold at which if we don't own enough, our incentives are to spend our time elsewhere, because we're trying to make that power law dynamic happen within this portfolio. And if we don't own enough of great companies, it may not necessarily achieve the kind of results we need. If there's an imbalance in any of the things described on this page, a lack of commitment or a lack of ownership for founders, a lack of ownership can lead to a lack of attention and engagement from investors. And a lack of ownership for employees can lead to the inability to hire and retain talent in a competitive market. All of this will get rolled up in a term sheet. A term sheet represents an agreement to work together towards an investment, and it typically captures all of the key business and legal terms of a contract. It will cover equity allocation, the type of security being invested, the liquidation preference structure. Most convertible preferred stock that venture firms invest in includes what's called a liquidation preference. That's the right to get paid back first if proceeds are going to be below a certain level. There may be a feature that enhances the performance of the investment called a participation feature. And the term sheet will include a description of how that equity converts to regular common shares. It will also include a discussion around protective provisions that deal with board governance, hiring, spending thresholds, the kind of things that need to be brought to a board, as well as, although it may be many years in the future, registration rights in the event of an IPO. It will talk broadly about investor rights to things like information and the sort of things that will be voted on by shareholders. And it will deal with the vesting of founder stakes and the overall structure of the option pool. It can seem like a lot. The things that really matter are the amount of money that's being raised, the price that's being put on the company, changes in the size of the option pool and the liquidation preference structure of the security, and then, of course, board composition. So let's talk about due diligence for a minute. What happens in due diligence? You know, due diligence is a sort of catch-all phrase for kind of background research on the company and the market opportunity. During due diligence, we are often calling management references. We are talking to prospective customers and partners. We're reviewing the details of the sales pipeline and probably producing our own more conservative view of it. We are trying to validate, to the extent that there's real innovation in the company, we're trying to validate the originality of the technology and get the perspective of outside experts. And we're looking at the market and the company's market entry strategy and the position of similarly situated competitors and major incumbents. And I'd say that of the things that give us pause, I mean, I'm speaking generically, not just about aerospace, the power of existing incumbents in a market, companies that have product that may, while on the face of it, be inferior to what a new company is bringing, is nevertheless in market, being sold, has effective sales and distribution. Those are the things that can scare an investor away faster than anything else. And lastly, of course, there's an element of legal due diligence that just has to do with the company being in good standing and well-formed and all shares of stock accounted for and that sort of thing. In 20 years of doing this, I have never seen a deal fail for legal diligence reasons. It's often because investors conclude, okay, there's just not as much momentum in the sales pipeline as we thought, or we discovered something in management references that alarms us, or we've concluded that the technology may not be that original overall. Those are the questions people are going to be focused on. Okay, let's look at the structure of startup rounds quickly and just call out a couple of the typical patterns. Your typical company is going to raise some startup and seed capital, and then a Series A, a Series B, a Series C, and perhaps a Series D round. So this rubric is meant to account for 5 sort of phases of investment. And what I've tried to do here is communicate a certain amount of who's involved at what stages. When you're just starting a company, who do you go to? Very often it's just friends and family at the start. You may have some R&D funding. We see a lot of that in aerospace. And then you may graduate to talking to more established individual angel investors, high net worth individuals who make investments in early stage companies, and seed funds. Throughout this entire ecosystem, we see family offices and their larger affiliates play in areas that are personally relevant either to the principles or to the mission of the entity. That's why they're on this page. By the time you're looking to raise Series A capital, you're past the R&D phase and you're approaching general availability of the product, and you're hopefully talking to your first customers. And that's when you're most likely to be talking to a firm like ours, but also to other angel and seed funds. You may be raising more friends and family rounds, and you may at that point be having your first conversations with strategic investors. And I would say, you know, once you've raised that Series A money, these top constituencies are your core audience for future rounds of financing. Strategic investors, when you get out into later rounds, private equity funds that do growth investing are particularly relevant in aerospace. We're seeing a lot of that right now. And venture capital firms like RRE are involved across the entire life cycle here as you go towards scaling revenue and the growth phase. Some of us skew a little earlier, some of us skew a little later, and you should do your research before you're pitching firms to understand where they line up on this continuum. So, you know, this process is also measured in years. When you raise capital, you're typically raising for kind of 15 to 18 months. And so the idea that the seed money you might raise in 2018, some of it, you know, may take you 18 to 24 months. And then it may be a year or two before you raise a B round. That's very typical. We as a firm tend to think about the company building process as a 5 to 10 year exercise. As this slide suggests, your mileage may vary. In our business, the average time to exit over the last 15 years has grown to 8 years. There's a lot that's been written about the number of companies in venture portfolios that have grown to great scale but still haven't achieved liquidity yet. And I think that's a common theme across the industry right now. Hold times are continuing to elongate in good companies. And the industry as a whole needs to find better solutions for achieving liquidity. That's not a topic for this call, but it is something for you to bear in mind as you go out and pitch firms, because a lot of the partners that you're pitching don't have a lot of capacity to take on new companies and new projects. So let's talk about seed rounds. Seed rounds are typically done as common or preferred stock, or in some cases a convertible note, a safe structure, very popular for some seed rounds. You're typically seeing people sell up to about 20%, and the sources of investment here are very often the entrepreneur themselves, friends and family, angel investors, occasionally VC seed programs like the one we have at RRE. And in that seed round, we're hoping to see a management team assemble a core group of founders, see that the basic business plan is in place, that there's hopefully some proof of concept achieved, and you know, the company's sort of up and running and constituted. The bottom line here is that seed round decisions are mostly made about the team. They're mostly made about the founding group. Can this group of people go off and achieve this audacious thing that they're talking about? And so the investors are focused on identifying the entrepreneurs, structuring the opportunity, and getting the company in business. And you know, this is part of the reason that the cadence of seed funds is often so high, because they're writing relatively small commitments into formative rounds for companies. Get it up and going, get the team on their way, and help them get to the next round, the Series A round. So Series A rounds are typically, you know, a much bigger deal. You will see companies sell up to about a third. This capital is really around operating the business, finalizing product development, very often about launching the product. There are usually a number of beta customers to talk to at this point. There's a very clear financial model and strong indications about the company's ability to price. And this is a point where the company is attracting serious professional investors. The venture firm that would likely lead this deal is going to be focused on verifying the business strategy through their due diligence. They're going to pay a lot of attention to the establishment of a board of directors. Unlike the seed round, where by and large it's not that we don't care about governance. We do care a lot about governance, but this is the point where you have a professional investor, an individual, making the commitment to join the board, and so there's often a lot more focus on board structure and on identifying key team needs and compensation programs and establishing the long-term professional services relationships to really help grow the company. As you move into the B round, you're probably going to take less dilution in this round and raise more money. Typical dilution is probably 15 to 28%. You might see some private equity firms start to participate here. More likely, it's still a venture firm like ours. And the management team should be pretty fully in place. This company should be generating revenue. The marketing strategy should be proving out. And to the extent that the strategies has needed to shift, this may be where you start to see shifts. The venture capitalist is deeply involved in all of these processes in a pretty informal way, whether it's filling out the management team, just being a daily sounding board for the CEO, helping to attract co-investors, that sort of thing. And finally, as we get to the liquidity phase, you should have, real, the idea and the concept has grown from a set of beliefs shared by the investors and the founding team into a business that can be valued, frankly, on a much more independent basis by a much wider audience. And this is the point where you're going public, you're taking that story of growth and the associated financial performance to market to raise additional capital through an IPO or late round private offering. And the venture firm may be involved in every aspect of that process. Okay, let's turn to some specific advice for entrepreneurs who are raising capital. One of the best things you can do as you target venture firms that you want to raise money from, and I really do mean target. You need to know who you're going to and why you're going to meet with them, down to a partner level. Find ways to generate excitement before you arrive. Have entrepreneurs who the firm has backed before call the partners who work there and say, hey, I hear that this great aerospace team is coming in to meet your partner. I just want you to know we think they're pretty exceptional. One or two phone calls like that can do a lot to set the table for you when you walk in the room, because venture investors, being very pressed for time, do spend a lot of their analysis triangulating. They triangulate on who thinks highly of this team, who thinks highly of this technology, who thinks highly of this market, and how credible is that voice in our world. So this is part of knowing your audience when you go in and understanding how decisions get made inside these firms. Do your homework. Understand who has political capital inside the partnership. Understand how fast or slow firms typically move. Understand what day of the week they make decisions. It used to be that all partner meetings seemed to happen on Mondays throughout the whole industry. And I actually, when I was young in this business and really trying hard to compete for deals, one of the very first things I would do with a management team that I liked is I would figure out where they were going to be on the next couple of Mondays, because I didn't want them presenting in other partner meetings before they got to mine. It's that level of thinking in terms of mapping out the decision-making process with the firm that you want, that you should be doing. You need to be able to articulate why your target firm fits your needs, and you need to be able to create some sense of competitiveness and scarcity. Sending a compelling message that says this deal is going to get financed, whether you guys invest in it or not, is a sort of important part of your process. The flip side of this is don't write a business plan like a dissertation. We recognize that an awful lot of analysis and planning has to go into building new companies. But ultimately, a lot of early stage decision making as an investor is about judgment. And the perfect business plan is wrong on the day that you finish writing it, because it can never account for the challenges and the surprises that will come up. And what we're trying to ascertain is not, did you write the perfect business plan, but how will you encounter how will you manage the challenges you encounter? How will you make good choices as things come up? Okay, more sort of specific advice. When you're pitching, get to the point fast, keep it to 12 to 15 slides. Make it really clear up front why you are the best possible team to do this and why you're going to win. Don't be afraid to be intellectually honest. You don't have an answer to every question. No one does. But you should be able to communicate concretely what you're going to need in the way of resources to succeed, what's going to prevent you from winning, what tectonic shifts could happen out there that push you to the sidelines, and how you're prepared to respond to those. And ultimately, recognize that it's the team and the strength of execution much more than the plan that matters. And so I love this question, what would happen if your business plan was posted on the web? The reality is that most of the ideas that we back have been around for a while. They're awash. The market is awash in good ideas, and the market is awash in innovation, frankly. What is scarce are great teams executing on those great ideas. As I said before, do your diligence on the firm, and make it really easy for the venture firm both to raise concerns or questions that people have, and also to describe what it would take for them to do a deal. Let's spend a few minutes on financials and the supporting business plans that go with them. This is about building a business, so you need financials. But for early stage ventures, it's hard to say that they are determinate. You need to be able to articulate to us how you achieve a high growth, high margin, repeatable business. I often tell my partners, you know, it's not that we can anticipate exits. Rather, what we have to do is focus on building valuable companies. So what is a valuable company? A valuable company can grow 100% every year, has gross margins in excess of 60%, preferably in excess of 80%, and can generate net operating margins in the 20s, and can do that in our world for less than 50 to 100 million of invested capital, and can get to, you know, $1 billion in revenue on that. That's the profile. That's what we're looking for. Your assumptions need to build to that kind of an income statement. And most financial models that are put in front of us reflect that, to be brutally honest. And so it's not that we can really perfect the cost per unit, the COGS per unit, but we should at this stage have a general idea of where those things are going to come out and the implications for margin. Same thing about channel costs, same thing about marketing costs, et cetera. My point is that it's very hard to write the perfect financial model at this stage. Okay, let's talk about the current environment for raising capital, and particularly for aerospace companies. I think as we look at the category, we see this new wave of innovation fueled by enormous technological advancements. Progress in autonomous flight, progress in componentry, and a lot of engagement and interest from industry players. I would say that you know, you can look at Uber Elevate, Airbus's Project Vahana, look at the things that Amazon is doing, look at kind of things like UPS, Zipline. There's an enormous amount of legacy industry focus on this sector. And if we look at kind of what's happening in drones and alongside the recent activity in VTOL, there's clearly a lot of engagement. I think there's going to continue to be M&A activity. The legacy industry is not sleeping here. The legacy industry is keenly aware that there's a lot of innovation happening here. One of their real leverage points is that raising capital for any new aerospace company is hard. And raising capital has to be a core competence of any team that you put together to build a new business. I often find entrepreneurs in the sector are surprised when I say this, but every deal we see in aerospace is technically viable. I mean, everyone, even the asteroid mining stuff that we have looked at is totally technically viable. It's whether or not the companies can raise the capital to get there. And there has been an abundance of seed and Series A capital in 2017. It accounted for 60% of the aerospace deals done last year. There's a real scarcity of capital at the sort of B and C round phases. I would also say that the bulk of the activity here is based in the US. 50% of the current VTOL companies are here in the US. 69% of drone and UAV startups have been based in the US. There are, of course, challenges which this audience is very familiar with that have to do with integrating with legacy public aerospace infrastructure, continued developments in this area, policy and regulatory developments. This is an area where I expect the big industry leaders to help the industry and to kind of the new aerospace companies to partner with them and kind of lead together. If we look at the drone sector as a proxy for what's happening in VTOL, let's talk about some notable recent activity. In 2017, the Series C at Airware, the $34 million for Swift Navigation, $29 million at Echodyne, and BDR's $53 million Series D. You're seeing venture funds, strategic investors, high net worth individuals, and you're seeing the same firms over and over again in these sectors. I mentioned a couple of notable acquisitions. They're listed down below in the drone sector: Flying Eye, Skyward, Pilatus, Interdrone. You know, I won't go through everything. The reality is there's real M&A activity happening in this sector. Some of it in terms of profitable outcomes, or to put it differently, some of it's on the steep side of the power law curve, and some of it's on the flatter side of the power law curve. Either way, frankly, that's a very good sign for the industry, broadly speaking. In VTOL, I think we have to highlight some notable recent financings. The Lilium financing, we watched this very closely, and here you have a strategic investor coming in alongside the early venture investors. Volocopter, led by Daimler, you know, EHang with GGV, and look at the Larry Page's financing of ZE Kitty Hawk. Here you have this wonderful pattern of high net worth individuals supporting next generation aerospace. It's a big factor, frankly, and one that is frankly helping drive a lot of innovation in the sector. Moving on, in the interest of time, let's turn to Q&A. I think we've got about 10 minutes left. Paul?
Yeah, great. Thanks for that great lecture. That was awesome. We've got a couple of questions in. And if you have other questions, anybody that's out there listening, feel free to put them either in the chat or the Q&A box, and we'll get to as many as we can. So first question, could you talk a little bit about how valuation is done by a venture capital firm?
Sure. So at its simplest level, valuation in a venture deal at the early stages is really a function of the capital at work and the rate of return that the venture investor is going to seek, more than it is a function of the intrinsic value of the idea. And so what do I mean by that? If you take a software company that needs to raise $2 million in its Series A, and a hardware and systems company that needs to raise, call it $7 million in its Series A. And in both cases, the objective to get to that Series A financing is product viability. And the management teams are going to give up 20% in both cases. Well, the deal that needs $2 million is going to give up 20% of the company, and the company is implicitly being valued at 10 million post. And we're assuming that the venture firm has essentially the same return objective from an ownership standpoint. The hardware and systems business that needs to raise $7 million, that's going to give up 20%, is implicitly being valued at 35 million post. Now, we've presented these two deals as equal in every respect, other than the fact that one needs more capital than the other. They probably have, potentially different outcome profiles, but the point holds true. The biggest variable in valuation at the earliest stages is the capital intensity of the business, because the reality is good teams are not going to give up more than 20% to a third of the equity of the business in that initial financing. And so in the back of the investor's mind, there is a return target. And it's a return target that is predicated on hitting that power law objective. I know as a venture firm that if I own 20% after the Series A, and if I continue to invest in future rounds, I'm going to suffer some dilution, but I'm still going to be in a position to own 10 to 15% of that good company when it ultimately has that exit. And if that exit it hits the kind of targets that I want, I can probably return that $100 million on $1 billion of exit value that I described in the opening example. That ultimately is a cost of capital assertion. The venture investor is applying a very high discount rate to the valuation of the company to implicitly say, I've got to have 20% for my money, whether the check is big or small, because I need to own a certain amount of the company at exit. Hope that clarifies things.
Yeah, great. Paraphrasing a little bit here, but you talked a little bit about the evaluating the teams of companies that you're looking at. So at this early stage in GoFly, some people might be working in very small teams and even teams of one. Could you talk a little bit about any advice you have for people working on very, very small or single person teams right now?
Yeah, I mean, I think those are often some of the best days of your life. I think you have to recognize that part of the opportunity in this category is around small, agile teams building new products that the legacy industry can only conceive of building with much larger, less integrated teams. And I think that the watchword I would have for those people who are doing team buildings in the early stages right now is you're looking for multi-hyphenates. You're looking for people who are not only electrical or systems engineers, but you're also looking for people who can do software development on top of it, and people who have real experience on the Q&A side of shipping commercial product. You're looking for people who are multidisciplinary. When I look at our most successful teams in our aerospace companies, there's very typically a core group of 5 to 8 engineers who are really broad in their skill sets and can also go very deep on fixing specific problems. That kind of agility is at the core of what makes for good teams in the early days.
Great, thanks. So VC firms often look for asymmetrical risk and reward profiles. How can teams and entrepreneurs participating in GoFly take advantage of that?
I mean, I'm not sure how best to encapsulate the idea of asymmetrical risk and reward profiles. I mean, our downside is limited to the capital we put in. Our upside is theoretically unlimited if things go really well. I think that we as investors look across a lot of categories where success is easier to come by than it is in aerospace. And when you start to talk about asymmetric, upside effects, network businesses are one of the best examples of this, right? So if I'm a node on a network and you're a node on a network and others are a node on the network, that network as a whole starts to have a lot of value. And there's a lot of great venture-backed businesses that have succeeded on that principle. Look at Twitter, look at Facebook, look at in the hardware and networking world, look at all the companies that were enabled by the growth of Ethernet, and all the companies that were enabled by the growth of IP. I think it's very hard to see those kind of network effects that can drive asymmetrical growth in aerospace, but there got to be some out there, and my hope is that this current wave of innovation is going to uncover some.
Great. Another question about small teams. Are early exits the best strategy for small teams, and how soon is the earliest somebody could look to start being a candidate for an exit?
Well, I think a lot depends on how you define success as a team, and how far you want to go, and how you weigh the trade-off between an early exit option and the risk of continuing to execute on your own. I think that the struggle, the paucity of capital at the sort of mid and later stages is going to force a lot of very good teams that have built very good early products to consider acquisition offers that they wouldn't take if they could raise capital. But either you've got the money or you don't to do the thing that you want to do. And so I think it's the smart entrepreneur is one who engages very early in discussions with potential corporate partners who could be go-to-market partners, strategic investors, and yes, acquirers. And for some small teams, that will be the right outcome.
Great, thanks. And then as a parting question, if you could offer one ingredient for success that you believe will be essential for GoFly teams, what would that be?
I'd like to offer two, if I could, because they're the two things that we don't see enough of. The first, which is challenging in aerospace, but that almost makes it more important, is get in business early. You learn the most when you sell a little, ship a little product, serve some customers, and then repeat that cycle with the next generation of your product. So the sooner that you are actually in business and selling something and generating revenue, the better you will be. And that across the board, across everything. The easier it will be for you to raise money, the easier it will be for you to effect an exit if you need to. So that's thing one. And thing two is really simple. Just don't underestimate the time and the effort that will have to go into raising capital. The venture market is not a reasonable or predictable market. Companies that have very little seem to get funded with huge amounts of capital. Companies that are doing exceptional breakthrough work and have great shipping product and customers, in the early stages, some of them seem to struggle to raise capital. It's usually either feast or famine. I've had an entrepreneur in my portfolio was raising money for 2 years before this summer he hit a bunch of important commercial milestones. And 3 or 4 venture firms were literally throwing deals at him. And so you have to design your company to deal with that capital market uncertainty. And if you do that, you will build a resilient organization. So thanks.
Great. Thank you for that. And sorry to anyone we didn't get to your question, but we're just out of time here. Gwen, would you like to send us off with some parting words?
Sure. Thank you all. And thank you very much, Will. You gave us an incredibly informative master talk on fundraising in the VC world and how to begin raising funds. So thank you very much. Just so everyone in the GoFly innovator ecosystem knows, we will be continuing to work with Will and additional fundraising experts to help you glean knowledge and to position you with the best possible knowledge for you to be able to raise funds. So thank you all. A special thank you to Will Porteous. And should you wish to learn more or to reach out to GoFly or Will regarding follow-ups, you can reach out to info@goflyprize.com, and we can forward information to Will or answer your questions that way. So thank you very much all. Thank you, Will.
Thank you, Gwen, and thank you, everyone. It was a pleasure. I really enjoyed it. Thanks for the opportunity.